$10 trillion dirt lie. Who is really buying up America's farmland? The $10 trillion lie, 100 words. The number looks harmless in a pension slide, $10 trillion. But that figure sits under your dinner plate. If farmland prices wobble, it won't be a paper loss. It'll be shelves, rents, and sovereignty. Here's the twist. The buyers shaping those acres don't live on county roads, and their names aren't on the mailboxes. The land has been sliced, collateralized, and traded far from the fields it feeds. If the land's ours, why does your grocery bill depend on a spreadsheet in New York? Let's test the story everyone repeats against the first hard evidence, the numbers that don't come from the soil. Financialized dirt, proof of the lie. Start with what this looks like in a kitchen, not a quarterly deck. A landlord, owned by a fund you'll never meet, emails a market adjustment. Rent jumps $42,000 across 1,200 acres. The term shrinks from 5 years to 2. The bank, seeing the shorter lease, trims the operating line by $80,000. Jake cancels a $19,500 cover crop plan and pushes fertilizer to chase yield. His daughter asks if they're still going to the county fair. He says, "We'll see," and means probably not. Now zoom out to how you can buy into that moment without touching dirt. You can log into a brokerage account and in seconds own shares of a farmland REIT. It looks simple. The trust collects rent from farmers, pays you a dividend, and touts diversification. Almonds in California, corn in Illinois, berries in Florida. Earnings calls talk about portfolio composition and weighted average lease terms. You almost never hear about aquifer drawdowns, salt buildup, or the cost of a fallow year. The story sells stability, the product sells liquidity. Here's what that liquidity means for real people. A private fund raises $350 million from pensions and insurers. It buys 18,000 acres across 3 states and lifts market rents by 8 to 12% to hit a target dividend. That's $24 to $48 more per acre, $28,800 to $57,600 per year on a 1,200 acre lease. The operator cuts a hired hand's hours, skips a $6,200 pump overhaul, and prays the motor survives July. A crowdfunding portal pitches own a slice of America for $10,000. The slice is a claim on someone else's season. When redemptions hit, parcels get listed. Comps fall. A local bank revalues collateral and shaves $50,000 off another operator's line. The pitch is access. The consequence is pressure. Now look at the numbers that make distance profitable. From the 1990s through the early 2020s, private farmland indices reported double-digit total returns on average. In several states, land values jumped 30 to 40% in under 3 years during the last cycle, while per-acre operating profits barely moved. Rents climbed faster than yields. The appreciation curve, not the harvest, carried the returns. That's the decoupling, price set by liquidity, not productivity. Here's how the flywheel turns. A fund acquires 10,000 acres across 3 states. Rising comparable sales lift the appraised net asset value. With a higher NAV, the fund borrows more on the portfolio, then buys more land. Each purchase becomes the next comp. The cycle repeats, higher marks, cheaper credit, larger balance sheet, more acquisitions. Meanwhile, tenant operators face steeper rent escalators to support those marks. The leverage sits on spreadsheets, the risk sits on tractors. Slogans smooth over the friction. They're not making more land lands well in a conference room, but arable land is shrinking in key basins, water costs are rising, and climate variance pushes yields off the model. The scarcity that's supposed to guarantee value is the same scarcity that erodes productivity. If price outruns what the ground can grow, the spread is speculation. Evidence of the transformation shows up in language. In filings and decks, fields become units, assets, stabilized rent streams. Soil becomes a risk factor, not an ecosystem. Dividend targets are clear, soil organic matter is incidental. The logic is familiar. In real estate, tenants pay monthly. In farmland, tenants pay by season. Either way, the cash flow is securitized. Trace the forms. Public REITs file quarterly. You can watch their acquisitions hopscotch between counties. Private funds disclose less but announce platform expansions into new regions. Crowdfunding vehicles spin up LLCs for each parcel and promise a secondary market later. ETFs build indices to track the category. Every layer boosts exposure without adding one agronomist to a lease review. What happens on the ground when exposure scales? Lease terms trend shorter, with ratchets tied to reference prices rather than field conditions. Some landlords benchmark rent to corn futures or regional caps rather than local moisture and inputs. In a drought year, the spreadsheet expects its due. Miss a payment and the lease can switch to a larger operator with the volume and equipment to meet aggressive yield targets. The system enforces the line item: rent first, resilience later. Look at water briefly, because it anchors the returns even when investors ignore it. In the High Plains, parts of the Ogallala support roughly a third of U.S. crop and animal production. Drawdowns there intersect with high-rent crops, corn for feed, thirsty nuts and specialty fruit in the West, kept on life support by irrigation pivots financed as capital improvements. Water rights ride with the deed, and the deed rides in a portfolio. The collateral is liquid because the aquifer is. Back to the balance sheet. Managers summarize risk as rate sensitivity. When borrowing costs were near zero, Farmland's perceived stability made debt look harmless. As rates rose, spreads compressed, and funds leaned harder on rent increases and asset sales. The pressure didn't show up on investor dashboards first. It showed up in operator margins, input deferrals, and delayed maintenance. You can defer a cover crop 1 year. You can't defer a debt covenant. Regulators aren't built for this market. Banking rules hit loans, real estate exemptions shield funds. There's no standardized reserve requirement for farmland portfolios or ratings for agricultural rent-backed products. Legal teams call farms infrastructure to thread statutes meant for roads and bridges. The capital moves faster than the oversight. Does the capital help? Sometimes. New irrigation, cold storage, or better roads can reduce loss and expand market access, but the upgrades are justified by return metrics first, and they're reversible. If commodity prices dip, the parcel pivots to solar, logistics, or land banking. The soil inherits the cycle, the community inherits the vacancy. So the proof of the lie is this: value is marketed as tied to the earth, but price is driven by tradable claims on the earth. Distance creates a buffer between the person who eats risk and the person who books yield. That buffer holds until weather, rates, or policy shove through it. Meanwhile, in kitchens, the pass-through is quiet. Rent pressure pushes crop choices toward water-heavy, price-chasing rotations. Volatility moves upstream into contracts and downstream into prices. When paper risk lands anywhere, it lands on a table where someone is deciding between milk and fuel. This is the moment everything changes. The chart looks safe until the basin runs dry, the lease resets, or the line of credit tightens. The system doesn't fall on Wall Street first. It bends a fence post, it closes a school, and then it shows up in your receipt. The origin: how dirt became a ticker. To understand how a field turned into a financial product, we need to go back to two hangovers: debt in the 1980s and doubt in 2008. Both moments reshaped who held the deed, why they held it, and what they expected from the ground beneath it. The first cleared the table for consolidation. The second set the terms for securitization. Between them, policy, tax code, and a culture shift turned soil into a spreadsheet. Start in the 1980s. Interest rates spiked. Commodity prices slumped. Farm debt that had looked manageable at 7% started resetting toward 15% and beyond. Land values fell hard. Families who had grown corn on quarter sections for 3 generations watched auctions draw strangers. Local banks took losses. Equipment got repossessed. The people who could buy were the ones with cash or access to it: regional operators, insurers, and early real estate vehicles. Foreclosure sales weren't just transactions, they were transfers of power. The land didn't move, but the command over it did. In the aftermath, a quiet consolidation took root. Fewer operators managed more acres. The agronomy stayed, the ownership changed. Debt discipline hardened into a mantra: never get over your skis. But the lesson didn't stick in the same way for everyone. Capital further from the weather remembered something else. Land could be acquired at scale when credit conditions turned and sold when they eased. That's not a farm strategy, that's a cycle strategy. Jump to the 2000s and the years after the housing crash. In a world burned by mortgage derivatives, farmland got pitched as the anti-bubble. It produced something people needed: It wasn't correlated to tech indices. The headlines about defaults were in Phoenix and Miami, not in county seats. A new investor class noticed. Pension funds needed steady returns to match obligations. Insurers needed duration. Endowments wanted inflation hedges. Farmland checked boxes in every deck. Scarcity narrative, visible collateral, long horizons. Policy greased the track. Real estate investment trusts had been around for decades, but pieces of the tax code and regulatory guidance clarified that agricultural real estate could qualify. Pair that with like-kind exchanges under Section 1031, and land could roll from one parcel into another without a recognized capital gain, so long as you stayed within the property family. Meanwhile, infrastructure language drifted. If a pipeline counted as infrastructure, why not an irrigation mainline? If a bridge's cash flows could be securitized, why not a long-term orchard lease? Ag as infrastructure entered memos and legal arguments. It wasn't about crops, it was about creating a compliant wrapper. Then came the low-rate era. For a decade, money was cheap. You couldn't get 5% on a safe bond, but you could show 5 to 7% on a farm lease plus appreciation, with volatility charts that looked flat compared to equities. The commodities supercycle flared around 2012, reinforcing the pitch. Grain prices surged, export demand looked durable, ethanol mandates locked in a demand floor. New funds launched with confidence. Securitized farmland didn't look speculative, it looked prudent. The culture followed the capital. Portfolio managers learned enough farm vocabulary to speak convincingly without getting mud on their boots. They hired acquisition teams to assemble multi-state portfolios and plugged agronomy into underwriting models as a tab: rainfall, soils, historical yields, next to cost of capital and tenant credit. Field variability flattened into risk scores. Yield meant two things at once: bushels and basis points. When the word holds two meanings, incentives choose one. Meanwhile, operating profit was reinterpreted. In an owner-operator model, yield variance and soil stewardship decisions were inseparable from wealth. In a landlord-tenant model optimized for securitization, those choices moved to the tenant's column while the owner secured the rent stream. That division made the next step logical: treat farm cash flows like other real estate, shorten lease terms to manage rate risk, embed escalators to protect returns, tie rents to external benchmarks to present a clean, predictable story to investors. You could see the scaffolding build in offering documents. REIT eligibility highlighted pass-through taxation and dividend requirements. Private placement memoranda described target IRRs supported by modest leverage and disciplined acquisition of undervalued acreage. 1031 exchange marketing promised a tax-efficient transition from apartments or industrial into mission-critical farmland. Infrastructure funds carved carve-outs: storage, water conveyance, on-farm energy. The legal architecture did more than permit ownership, it standardized it. Here's where low rates amplified belief. If you can borrow at 3% and lease at 5% with an appreciation tailwind, you look like a genius. Rising NAVs validated the thesis. Boards approved more allocations. Consultants circulated cross-asset scatterplots with farmland in the low volatility, steady return quadrant. Articles praised land's resilience. Even regulators, wary after housing, didn't see the same red flags because the leverage was often at the fund level, not strapped to individual farmers in public view. But the conversion wasn't only financial, it was linguistic. In meetings, managers referred to purchases as programmatic acquisitions. They showed heat maps of exposure. They spoke about tenant mix and crop diversification strategy as if they were discussing malls and anchor stores. The business of feeding people was reframed as a business of renting ground to producers who survived the bid. The era didn't eliminate husbandry, it subordinated it to quarterly marks. What nobody saw clearly at first was the second asset bundled with the first: water. In many basins, the deed carries groundwater rights or surface rights sit in the same corporate structure. A fund that bought an orchard or a block of row crop land acquired the right to draw from aquifers or canals. In the high plains, that meant tapping a giant but declining savings account. In the West, that meant banking seniority in priority systems older than the funds themselves. Water became an unpriced hedge. If returns dipped, The value embedded in rights could backstop the thesis. That set up a quiet race to pump, pipe, or monetize scarcity. While capital discovered water, policy helped again. States stretched to define beneficial use, transfers, and storage. Municipalities wrote long-term water plans that opened doors for private partnerships, transfers, or leases of agricultural rights to cities. Some funds started marketing water optionality in their materials. Others kept it under the headline of resource security. Either way, the soil penciled because the water did. The spreadsheet didn't have to name it to rely on it. Internally, the pitch evolved after 2015. With spreads narrowing in traditional real estate, Farmland moved from alternative corner to a slide near the core allocation section. Advisors built model portfolios, 5% farmland exposure alongside timber, infrastructure, and private credit. The argument wasn't just return, it was correlation. Farmland's line moved differently than stocks, they said, so even a small slice smoothed the ride. Smoothing became a selling point as much as yield. At the same time, technology put a sheen on the story. Precision ag platforms promised data-driven farming. Funds showcased drone footage, NDVI maps, and dashboards translating hectares into heat maps. Sensors measured moisture, pivots logged cycles, tractors streamed telemetry. The data made the business feel modern and controllable. But who owned the data? Often not the person on the tractor. Contracts buried rights to aggregate and anonymize field-level intelligence, moving value upstream to platforms and owners. The field became an input generator for someone else's edge. The result was a mind shift that reached even cautious boards. If an asset can be measured, it can be modeled. If it can be modeled, it can be underwritten. If it can be underwritten, it can be scaled. Scale justified management fees. Fees justified headcount. Headcount justified more product. The feedback loop wasn't evil, it was efficient. But it was indifferent to the one variable no spreadsheet can fix: moisture in the right place at the right time. Meanwhile, the underlying agriculture kept cycling. Prices swung with weather and trade. Input costs rose and fell with energy and geopolitics. Farmers adapted, as they always do, but lease pressure changed the range of acceptable choices. When owners promised fixed returns to outside capital, tenants absorbed variance through tighter rotations, heavier irrigation, or higher-risk crops chasing price spikes. Those weren't just farm decisions, they were balance sheet decisions made at a distance. There was a final accelerant: stories. They're not making more land. Food is the new oil. Hard assets in uncertain times. These lines weren't true or false in a simple way. They were compact ways to convert fear into allocation. They turned weather into narrative and narrative into capital. The more they were repeated, the more they became the baseline for price, regardless of field conditions. That's how a patch of earth becomes a ticker. Belief finds structure, structure finds leverage, leverage finds a story. When rates climbed off the floor, the model didn't break. It adjusted. Managers extended lease escalators. They trimmed distributions to preserve liquidity. They sold non-core parcels. Some pivoted acreage to solar where interconnection allowed. Others packaged water assets for transfer or long-term leases to municipalities. Flexibility was a feature when the spreadsheet owned the deed, but that flexibility had an opposite face for communities. A pivot away from crops meant fewer seasonal jobs, fewer purchases at the co-op, fewer kids in the school. Balance sheet resilience didn't look like resilience in town. If this all sounds inevitable, it was. It was assembled step by step. A crisis that redistributed ownership, a tax code that rewarded rolling gains, rates that made debt feel painless, instruments that turned cash flows into dividends, a culture that accepted remote control over local necessities, and a hydrology that could be tapped without immediate consequence. Each piece made sense alone. Together, they made farmland behave like a financial product with a pantry attached. Meanwhile, under the fields, the quieter asset kept ticking down. Aquifers in stressed basins fell faster where rent targets met drought. Irrigation became a capital improvement to defend marks. Water tables didn't care about IRRs, they cared about withdrawals. And as scarcity deepened, the implicit value of water rights inside land portfolios rose, making the underlying temptation stronger. Pump now, justify later, transfer if you can, monetize if you must. Before we go underground and follow those rights through pipes and statutes, meet the people carrying the risk you don't see on an investor slide. The tenants whose names are on the checks, not the deeds. They're the ones who get the email that says the lease is being repriced to market. They're the ones who choose between paying rent and letting a field rest. They're the ones whose decisions define whether your grocery bill is calm this season or not. Farmers on the hook lives in the margin. Start with a Tuesday email. Subject line, lease adjustment, effective next season. Jake reads it at the kitchen table while his daughter finishes homework. 3 lines down, the number stings, rent up 12%, term shortened from 5 years to 2, benchmarked to a regional corn index that never heard of last summer's hail. He calls the property manager and gets a dashboard answer. It's just bringing you to market. Market doesn't know the name of his dog or the creek that stalled planting for 8 days. Market wants the check. The stakes land in small choices that don't look like drama until you run a season through them. Higher rent pulls fallow out of the rotation. Cover crops turn into maybe next year. Fertilizer rates creep up to chase a yield that pays the landlord first. Jake doesn't need a lecture on soil health. He's got a folder full of test results and a notebook that lists field quirks in pencil. But he can't write a check with ideal practices. He pays with bushels and time. Meanwhile, leases keep getting shorter. 2-year terms feel like a countdown clock. Banks notice. Credit lines tied to operating plans start asking for contingencies. What if you lose 320 acres? Who takes the pivot debt if the landlord ends the lease? Jake's answer is always the same. He'll find acres, he'll move equipment, he'll grind. But equipment doesn't like musical chairs. Neither do hired hands who need steady hours. Short terms move risk from the owner's column to the operators, then act surprised when operators act like they're in a sprint. Then there's the algorithm. In a dry year, Sam, a wheat grower in western Kansas, misses a rent milestone by a hair. The landlord's portal tracks performance to plan. The dashboard flashes red. A week later, a form letter ends the lease. No conversation. A larger operator, pre-approved by the fund, steps in with a promise to meet a higher yield benchmark based on a model that never sat in Sam's combine. Sam trucks his grain past fields he planted to a bin he doesn't get to fill anymore. Those aren't outliers, they're instructions written by incentives. When funds promise steady returns, variability has to go somewhere. It slides into the grower's decisions, the kind you make at dusk when you want to rest a field but can't pencil it. A shorter lease means you extract, not invest. You pick a high-dollar crop with a thirst you'll pay for later. You skip a margin cushion to hit a rent ratchet you didn't set. Follow the water because the rent demands it. Alicia leases 200 acres of vegetables in Arizona under an LLC chain she's never untangled. Her landlord, a private partnership, added a clause: irrigation improvements count as tenant capital unless the owner buys them out at a depreciated schedule. Alicia installs drip to keep beds alive in late summer. The return is survival, not appreciation. The next year, rent climbs because yields looked resilient. The drip line now props up a higher price she has to meet. Water becomes both lifeline and leash. Crop choice shifts under that pressure. In the high plains, irrigated corn keeps rent current where dryland sorghum might conserve moisture but miss the target. In California, almonds fill spreadsheets with tidy projections and bite into aquifers when rain forgets. On paper, rights accompany deeds. In practice, tenants face the moral math of pumping today to protect this year's balance sheet. The aquifer falls by inches, the lease rises by basis points. Human costs show up off-farm first. The co-op trims hours because orders arrive late. The school consolidates classes when a couple of families move after losing leases. The diner cuts breakfast Monday and Tuesday. Rural towns run on farm margin. When lease terms skim that margin to stabilize distant returns, services don't argue, they shrink. You don't see a crash. You hear silence at a Friday night ball game where the visiting team brings more fans than the home stands. There's a quieter squeeze, the upgrade trap. Tenants take on equipment payments sized for a stretched footprint because that's what it takes to win leases from landlords who want capacity. Bigger planters, newer combines, more pivots. The math skills are not the problem, the time horizon is. If a lease evaporates, capacity turns into overhead. Overhead hunts acres to feed itself. The hunt pushes bids up. A local operator loses to a platform that can absorb a short year with portfolio cash flow. The cycle rewards scale and penalizes patience. Not every landlord is indifferent. Some local owners keep rates fair, tie bumps to field conditions, and share drought pain. But the financialized slice grows, and with it the preference for rules that travel well. Rules like escalators indexed to futures. Rules like automatic termination on underperformance measured against a model that doesn't know what wind did to a north fence. Empathy gets priced as tracking error. Look at a micro story in Illinois. Naomi runs a soybean corn rotation on 1,100 leased acres across 4 landlords. After a wet spring, she proposes a switch to a cover crop-heavy plan to rebuild structure on 240 acres. 2 landlords agree, 2 say the rental escalator expects a conventional rotation, and deviation requires prior approval from investment. Investment answers in 2 weeks, no. Naomi plants the higher-risk rotation and pays more for nitrogen because she can't push the improvement timeline past a lease term. Her agronomist shakes his head. The soil knows what it wants. The spreadsheet knows what it's sold. When people ask whether this shows up in grocery stores, the answer is dull and heavy. Yes, but not as a headline. Price volatility gets passed through one contract at a time. A processor raises basis by a few cents to secure supply from operators who had to hit rent. A packer adjusts pricing after a season where high evaporation years trimmed yields. Households don't see a REIT name on the receipt. They feel a wobble in milk, eggs, and bread just when fuel climbs too. The chain is invisible by design. Underneath, stress loads bodies.